The next thing we will start talking about today is receivables. We have been talking a lot about receivables, mostly about accounts receivable. So in this chapter we will discuss accounts receivable and notes receivable. So let's start. Usually there are different types of receivables. The most common ones are accounts receivable, and we have also notes receivable. Accounts receivable are when the company makes a sale or provides a service on account. This is money that their customers owe them. Okay? Notes receivable are very similar. Usually they have a longer periods of time and they have a more formal documentation. Plus, most of the time they actually incur interest. They need to earn an interest by the company. So the company, because they have notes receivable. We saw that in the bank reconciliation. They collected notes receivable, they received interest on that because of that as well. And then you have additional other receivables basically. Those are like from tax refunds. Those are money that the company lends to their employees and they expect them to pay them back, etc. Okay? Sometimes they have also like interest receivable. This slide here simply shows you why we care so much about accounts receivable. Because in certain cases, it makes up a big part of the company's current assets. Okay? This comes from the company's operations, and most companies, they actually make transactions on account. So this is why you would have, for example, General Electric, they would have 52% of their assets were 52% of their assets, like half their assets were in receivables. Okay? So for accounts receivable, there are three main issues that are associated with that. Now, the first thing is you need to know when to recognize them. That's easy. Right? When do you recognize an account receivable? Either when the company makes a sale or provides a service. When the company earns their revenue on account, if they provide a service on account, you debit accounts receivable. If they make a sale on account, you debit accounts receivable. The second part is a little bit trickier. Valuing accounts receivable. And why is that? So we know that we are going to report it, but at which value? The problem with accounts receivable is that part of those receivables will never be collected. You will always have some customers who default on the payment, right? So instead of making the payment, instead of paying their debt, they might go bankrupt. If your customer went bankrupt, they are not going to pay you the money. Or there is a possibility. It's not for sure, but there is a possibility that you will never collect that money. So this is what we talk about when we talk about valuing them. Okay? So let's start with this one. Assume that the company sells merchandise on account to Polo Company for $1,000, terms 210 net 30. You need to prepare the journal entry to record that transaction. You made a sale on account. So what happens? You debit what? Accounts receivable, you credit sales revenue. Now later on, the customer returns $100 worth of merchandise. Now the money that you expect to receive will go down by 100, right? By the way, here, although we're making sales, we are not looking at the second part. Remember, we usually make two transactions. The first one to recognize the sale, the second one, cost of goods sold and inventory. For the sake of making it simpler, we're not looking at the second entry. We're only focusing at this one on the receivable. Okay? So in this case, the company will return, and when you have sales, returns and allowances, that's a contra revenue. What do we credit? Accounts receivable. We did that before. This is why I'm going fast, because we did all this before. Okay? So what we did, the company or the customer returned to the company goods that are worth, basically that were the sales that were sold for $100. Okay? On July 11, the company also received a payment. That was within the discount period, right? So, how do we used to do that? Cash would be the full amount minus the discount. Then we have sales discount, okay, which is, it's 2% multiplied by the net sales. Remember, not the ones that will return. Accounts receivable will be credited to $900. Okay? Now, in certain cases, there are certain retailers who might issue their cards. So basically, you have those sold cards, right? Macy's does that, JCPenney, etc. And if by the end of the month, if you don't make the payment, they will charge you a certain interest. Okay? Now, if you use a credit card to make the purchase, that will be, again, it's a purchase on account. So what happens? How is the entry made? It will be, again, for JCPenney, it would be sales revenue and accounts receivable. At the end of the month, if they don't make the payment, what will happen? If you are the customer does not make the payment, JCPenney will earn interest. The interest is 1.5%, for example. So they will have interest. Basically, this is interest revenue. But because you haven't paid, if you haven't paid the full amount, you're not going to pay the interest. They will charge you interest. It becomes accounts receivable as well. In this case, their account receivable will be the original amount plus the interest that was to be paid, that is to be paid. Any questions? We will continue about the valuations on